If you've been relying on the RSI to catch the trend reversals, you might be missing out on something way more accurate. The Commodity Channel Index, or CCI, is the secret weapon hardly anyone's talking about. While RSI is on every trader's chart, CCI is quietly delivering faster, sharper signals, especially when combined with moving average crossovers. But wait, what exactly makes CCI different? Why are professional traders using it for cleaner entries and earlier exits? And how does it stack up when paired with exponential moving averages? Most indicators either show you momentum or trend, but the CCI, it does both. And when you blend it with two well-placed EMAs, you start filtering out the noise. That's when your trading gets dangerous, in a good way. Today, you're going to discover a trading strategy that could outperform RSI using nothing more than the CCI, 2 EMAs, and one key confirmation. It's simple, it's powerful, and it works across forex, crypto, and stocks. By the end of this video, you'll know the real reason CCI can spot momentum shifts before RSI does, how to set up the EMA crossover for trend confirmation, and exactly how to enter trades with confidence, no guesswork. We'll walk through real charts, test the system, break down the rules, and expose when this strategy fails, so you're protected from false hope. This isn't another copy this setup video. This is about giving you the logic to think like a strategist, so you're not just reacting, you're anticipating. Let's dive in. The logic behind the strategy. Most retail traders fall into the same trap, stacking up indicators that tell them the same thing. RSI, MACD, stochastics, all measuring momentum in slightly different ways. But here's the problem. Using overlapping tools gives you the illusion of confirmation, when in reality, it's just noise. The magic happens when you combine different types of indicators, ones that measure different things. That's where the CCI plus EMA crossover strategy comes in. CCI, unlike RSI, isn't just a momentum oscillator. It's a deviation-based tool. It measures how far price deviates from its statistical average. And that gives you a powerful edge. It doesn't just tell you when a market is overbought or oversold. It reveals when the market is behaving abnormally fast in one direction. Think of it like a speedometer. RSI tells you how fast you're going. CCI tells you how far you've gone off track from the average path. That's a big difference, especially when you want to catch explosive moves before the rest of the market sees them. Now combine that with an EMA crossover. EMAs, especially the 20 and 50 period, are great at showing trend shifts. When the fast EMA crosses above the slow one, you're seeing fresh trend momentum. And when that crossover happens, just as the CCI breaks above plus 100 or below minus 100, that's when we strike. The crossover tells us the direction, the CCI tells us the timing. This combo works because it filters out the biggest enemy of traders, false signals. By waiting for both conditions, the EMA crossover and the CCI level break, we're aligning two key forces, momentum and deviation. That creates entries that are based on real price behavior, not lagging confirmation. And here's the kicker. You can add a candlestick pattern for the final green light. A simple engulfing candle, pin bar, or inside bar can be your sniper entry. You're not relying on guesswork. You've got a system. So to recap, EMA crossover equals trend shift. CCI breakout equals momentum deviation. Candlestick equals precise entry. It's clean, it's logical, and when used correctly, it keeps you on the right side of the market. Even better on it, this combination adapts well to different time frames and asset classes. Whether you trade forex pairs like Euro to USD or crypto pairs like BTC to USTD, the principles stay the same. And that's what makes it so scalable. In the next section, we'll break down exactly how these EMAs behave, how to choose your EMA pair, and why the crossover is such a critical piece of the puzzle. How moving average crossovers work. Moving average crossovers are like the heartbeat of trend trading. Simple, visual, and insanely effective when you understand what's really happening underneath. Let's start with the basics. An exponential moving average, or EMA, gives more weight to recent price action. That makes it more responsive than a simple moving average. So when traders talk about using a 20 EMA and a 50 EMA, what they're really doing is tracking short-term versus medium-term momentum. Now here's the key. When the 20 EMA crosses above the 50 EMA, it signals that recent price action is gaining strength, that the bulls are pushing harder than the historical average. That's called a bullish crossover. And the opposite? When the 20 EMA crosses below the 50 EMA, recent price is weakening compared to the longer-term average. That's a bearish crossover, and it often signals the start of a new downtrend. But don't get fooled. Not every crossover means a trend is guaranteed. In sideways or choppy markets, EMAs can whip around and generate false signals. That's why we combine the crossover with the CCI to make sure price isn't just drifting, but actually accelerating with momentum. So what does this look like in practice? Imagine a chart where the 50 EMA is gently sloping down and the 20 EMA suddenly curves upward and crosses above it. That's not just a line crossing another line. It's a shift in sentiment. Buyers are stepping in with force. And when you overlay the CCI and it crosses plus 100 at the same time, that tells you not only what's happening, but why it's worth acting on. Another smart way to read crossovers is by observing the angle and distance between the EMAs. A steep angle means strong momentum. A wide gap after the crossover means the move has legs. A flat crossover with little spacing, high risk, low conviction, probably a fake out. Also, context matters. A bullish EMA crossover happening just above a key support level, that's a confluence setup. It adds layers of conviction. Smart traders never use crossovers in isolation. They use them in context with structure, volume, and confirmation tools like the CCI. And here's something most beginners miss. EMAs don't just signal new trends, they guide trade management. When you're in a long trade, the 20 EMA can act as a dynamic trailing stop. If price closes below it, especially after a crossover, that might be your cue to exit and lock in profits. One more tip. Crossovers are even more powerful when they line up across multiple time frames. If the 1-hour chart shows a bullish crossover and the 4-hour agrees, you've got alignment. And that's where the biggest moves happen. Now that we've covered the engine behind trend detection, it's time to zoom in on the indicator that makes this strategy deadly accurate. Section 4, Deep Dive, the CCI indicator. The Commodity Channel Index, or CCI, is one of the most underrated tools in technical analysis. While most traders are glued to RSI or MACD, the CCI quietly gives earlier signals and sharper warnings, if you know how to read it. So what exactly is the CCI measuring? In simple terms, it calculates how far the current price is from its average price over a period of time, usually 14 or 20 candles. When the CCI value is high, it means price is trading significantly above its average. When it's low, price is well below its average. This concept is called price deviation, and that's where the edge lies. Instead of just showing overbought or oversold, the CCI shows how unusual current momentum is compared to historical movement. It's less about fixed limits and more about recognizing extremes. By default, CCI moves between plus 100 and minus 100, but it's not capped like RSI. That's important, because when the CCI breaks out beyond these thresholds, it's telling you price isn't just trending, it's accelerating away from the mean. That's the sweet spot for trend entries. Think of it this way. RSI might scream overbought at the exact moment a strong trend is beginning. But the CCI, it tells you that yes, price is stretched, but in a way that could keep going. It helps you ride waves, not fear them. Now, how do we use it? When the CCI breaks above plus 100, that's a bullish signal. It means buyers are pushing hard enough to break the standard volatility range. Below minus 100, same logic. Sellers are in control, and momentum is accelerating downward. But here's where things get powerful. You don't just enter on a CCI break, you combine that signal with structure, like an EMA crossover, and possibly price action confirmation. Some advanced traders even split the CCI into zones plus 100 to plus 200 equals strong bullish momentum, minus 100 to minus 200 equals strong bearish momentum, beyond plus or minus 200 equals extreme conditions, often in parabolic moves. And unlike RSI, which flattens out, the CCI can spike hard. That gives you an edge in spotting explosive price behavior early, before the crowd catches on. Another key detail, the speed of the CCI signal. Because it reacts quickly to changes in momentum, it often flashes before moving averages even begin to turn. That makes it ideal for early entries and tight risk-reward setups. It's also adaptable. You can use a 14-period CCI for short-term trades or a 50-period CCI for swing setups. The core logic stays the same. Find where price is deviating with momentum. So now you understand why the CCI isn't just a momentum indicator, it's a tool for reading urgency. That's what makes it deadly effective when paired with trend confirmation from EMAs. Coming up next, the complete strategy rules: long, short, entry, stop loss, and how to stack your odds. The full strategy breakdown. All right, now that you know how CCI and EMAs work, let's build the strategy. This setup is designed to catch trend continuation with precision while avoiding most of the false signals that kill beginner traders. It's clean, simple, and scalable across forex, crypto, and stocks. Let's break it down step by step. Indicators you'll use: 20 EMA, fast; 50 EMA, slow; CCI, 20 period. Optional, candlestick pattern overlay for entry confirmation. Long setup rules, trend confirmation. The 20 EMA must cross above the 50 EMA. Both EMAs should be sloping upward. Flat EMAs, sure avoid. Momentum confirmation, CCI must break and close above plus 100. Higher confirmation if CCI hits plus 150 or beyond, shows strong push. Price action confirmation, optional but powerful. Look for a bullish engulfing candle, pin bar, or breakout candle aligning with the CCI breakout. Entry, enter on the next candle open after all conditions align. Conservative traders can wait for a retest of the EMAs for better entry. Stop loss, place SL just below the most recent swing low, or slightly under the 50 EMA. Take profit, TP1, 1.5x your risk, secure partial profits. TP2, trail with the 20 EMA until a clean break below. Red short setup rules. Trend confirmation. The 20 EMA must cross below the 50 EMA. Both EMAs should be sloping downward. Momentum confirmation. CCI must break and close below minus 100. Stronger if CCI dips past negative 150. Candlestick confirmation. Optional. Look for a bearish engulfing shooting star or breakdown candle after the CCI signal. Entry. Enter at the next candle following signal alignment. Retests of 20 EMA make great sniper entries. Stop loss. Just above recent swing high or above 50 EMA. Take profit, TP1 at 1.5R, TP2 trailing below 20 EMA. Pro tips to maximize performance. Avoid trading this in sideways or ranging markets. Use a higher time frame to spot clean trends first. Use volume spikes as extra confirmation. If CCI breaks plus 100 and volume jumps, that's fuel. Stay out during news events unless your system includes a volatility filter. Backtest across multiple pairs and timeframes. This works beautifully on the 15-minute, 1 hour, and 4 hour charts. This strategy combines three things the market always respects: trend, momentum, and confirmation. When you stack those layers, you're not just guessing, you're building probability into every trade. Next up, let's test it on real charts, including EUR/USD and BTC/USD, and see how this strategy plays out in action. Backtesting and examples. Now it's time to put this strategy to the test. Let's see how it performs on real charts. We'll start with EUR/USD on the 1-hour time frame. This pair is perfect because it trends cleanly and respects technical indicators. Here's a textbook long setup. The 20 EMA crosses above the 50 EMA. Clean trend forming. CCI breaks plus 100 with a sharp bullish candle. Momentum confirmed. A bullish engulfing candle forms at the same time. Entry on next candle open. Stop loss set just under the last swing low. TP1 hits quickly at 1.5 R. Price continues trending, trailing 20 EMA locks in more profit. Perfect execution. Now let's test a short example on BTC/USD 15-minute chart. Ideal for active traders. Price consolidates, then the 20 EMA crosses below the 50 EMA. CCI dives under minus 100, followed by a bearish breakdown candle. Entry on next candle, SL above swing high, and TP1 hits with a clean move. As price continues to drop, we trail using the 20 EMA and exit when it crosses back above. These examples show how the setup adapts across assets and timeframes. But not every trade is perfect. Let's also look at a failed setup. In GBP/JPY, you might see the 2050 EMA crossover and a CCI breakout. But here's the issue. EMAs are flat and volume is low. No momentum. You take the trade, but it quickly pulls back and hits SM. This reminds us, technical alignment isn't enough if the broader market isn't cooperating. That's why filtering trades based on trend quality and volume is so important. You need momentum, not just signals. Now imagine you backtested this strategy across 100 setups, and your win rate is around 60% with a 1.5 R average return. That's a real statistical edge. And more importantly, it's scalable. The real power comes from repetition and review. Use tools like TradingView to mark up historical setups, journal each trade, and track stats. Over time, you'll identify your personal strengths, improve your timing, and eliminate low-quality setups. Up next, we'll talk about when this strategy fails and how to avoid common traps that can sabotage your success. Mistakes and when the strategy fails. Even a solid strategy can fail, and knowing when not to trade is just as important as knowing when to enter. Let's break down the most common situations where this CCI plus EMA system underperforms. First, ranging markets. When price chops sideways and EMAs are flat, this strategy becomes unreliable. You'll see fake CCI breakouts that quickly reverse and EMAs that cross back and forth. Avoid these zones entirely. If there's no trend, skip the trade. Second, low volume conditions. If volume is dropping off and the market feels sluggish, it's usually not the time to trade. CCI signals rely on momentum, and without enough activity, you're more likely to get trapped in weak moves. Always scan volume before entering. Third, news events and high volatility spikes. The strategy isn't built for trading during wild, unpredictable price action. A sudden news release can make a perfect setup fail instantly. Either use a news filter or stay flat during those periods. Protect your capital. Fourth, EMA misalignment across timeframes. If the EMAs show a bullish crossover on the 15-minute, but the 1 hour still shows a bearish trend, that's a red flag. You want alignment for stronger trades. Mismatched signals equals conflicting momentum, which weakens your edge. Fifth, forcing trades out of boredom. Sometimes traders feel like they have to be in a trade. But if you force entries without real signals, you're just feeding the market your capital. Patience pays. Sixth, ignoring context. Just because your rules align doesn't mean the trade makes sense. Step back, check the bigger picture. Are you trading into major resistance? Is the market unstable? Bottom line, this strategy works best in clean, trending environments with strong volume and alignment. Your job is to wait patiently for those moments. If you can do that, losses shrink and wins expand. Now, let's wrap things up with one last actionable tip and a quick recap. Section 8, Final Thoughts in CTA, extended to approximately 100 words. You now have a complete strategy that combines trend, momentum, and confirmation. 3 pillars of successful trading. Use the CCI and EMA cross as your foundation. Layer in smart entries with candlestick confirmation, and always protect your trades with solid stop loss and take profit rules. Remember, mastery comes through consistent practice, patience, and honest review. Backtest thoroughly, journal every setup, and stay disciplined through ups and downs. If you found value in this breakdown, smash that like button, subscribe for more real-world strategies, and drop a comment sharing your favorite indicator combo. Let's grow your edge, one trade at a time. Thanks for watching.